have you ever looked at your portfolio and thought, why on earth did the Indian market just react so sharply to a headline from halfway across the world? Well, in today's Explainer, we're going to connect those dots. We'll break down exactly how global financial headlines, specifically inflation data and US Federal Reserve decisions, actually impact your personal wealth right here at home.
So why should you, as an Indian investor, really care about a boardroom decision made all the way in Washington? I mean, it seems totally disconnected, right? But the truth is, a single interest rate decision made in the US creates this massive ripple effect. It touches the Indian rupee, it shifts foreign investor flows, and ultimately, it directly impacts your long-term financial planning.
To truly understand these global ripples, we really have to start with the most universal economic concept of them all. Section 1. The reality of inflation and its effect on your purchasing power. Think about inflation as this invisible force that just quietly shrinks your purchasing power. Imagine your monthly household expenses were exactly 50,000 rupees last year. But today, maintaining that exact same lifestyle, buying the exact same things, cost you 55,000 rupees. That difference? That is inflation in action. It hits everything: your groceries, fuel, education. And if your savings are just sitting there idle, growing slower than this inflation rate, the real actual value of your hard-earned money is literally shrinking.
Now, to know if inflation is getting out of hand, we need a baseline for what's normal. Here in India, the Reserve Bank of India aims to keep consumer inflation right around the 4% mark, with a bit of a tolerance band between 2 and 6%. This target is basically the sweet spot. It keeps the economy stable while still supporting growth. But what happens when the numbers break out of that comfort zone?
Well, that brings us to Section 2, Central Banks Taking Action, which is all about balancing the economy.
When inflation gets too hot, central banks have to step in. Think of it like a giant economic seesaw. Both our RBI and the US Fed use interest rates to balance things out. If inflation is running way too high, they're going to hike interest rates to cool down spending. On the flip side, if inflation drops and the economy starts slowing down, they might cut rates to encourage people to borrow and spend again. It is a constant, delicate balancing act.
Okay, so we know how inflation works locally. Let's shift our focus to the international stage with Section 3, Global Money and India, and start connecting those dots.
The US Fed's decisions basically impact India through 3 main channels. When US interest rates are high, global investors look at US bonds and think, hey, that's a really safe, attractive bet right now. Because of that, foreign investors, or FIIs, might pull their money out of emerging markets like India to chase those higher yields. This shift in foreign investor flows instantly triggers the next 2 channels: currency movement and overall market sentiment.
Let's look a little closer at that second channel right now in Section 4, Currency Impact, and explore why rupee movement matters.
The really fascinating thing here is that a fluctuating rupee doesn't impact everyone the same way. When high US rates make foreign currencies stronger, the rupee naturally weakens. Now, on one hand, this definitely makes our imports, things like crude oil and heavy machinery, much costlier in rupee terms, which adds pressure to our local inflation. But wait, on the flip side, a weaker rupee is actually fantastic for our export businesses and IT services. Why? Because the money they earn internationally translates to a whole lot more rupees when they bring it back home.
With all these massive global forces pulling the economy in different directions, it's completely natural to see some turbulence. Let's get into Section 5, Market Volatility Explained.
This dynamic right here is exactly why you absolutely shouldn't panic when you read flashy headlines about FIIs pulling money out of India. Yes, foreign selling creates some short-term pressure, but Indian markets today have this incredibly robust domestic support system. Domestic institutional investors, which are driven by your monthly SIPs, your mutual funds, and everyday retail investors, act as a massive shock absorber. We aren't just at the mercy of global flows anymore, guys. Our domestic strength keeps the market incredibly resilient.
So, understanding the macroeconomics is great, but what does it mean for your money? Welcome to Section 6, Investment Strategy and Smart Planning for Your Portfolio.
Here is your actionable checklist from GEPL Capital to help you survive and honestly thrive through any market cycle. First up, proper asset allocation across equity, debt, and gold. Second, diversification, so you're never relying on just one single sector. Third, regular review of your financial goals. Fourth, disciplined investing, meaning you ignore the daily noise. And finally, risk management that actually matches your time horizon. This structured approach is going to protect your purchasing power way better than reacting to whatever is trending in the news today.
Look, inflation and interest rates, they're always going to fluctuate, and there will always be breaking news trying to scare you.
But disciplined investing is how you navigate all that uncertainty with total confidence. Goal-based planning is your ultimate anchor here. Don't let temporary ups and downs derail your financial journey. Build your portfolio to withstand these global tides and let GEPL Capital be your steady guide through absolutely every macroeconomic shift.
Keep focusing on those long-term goals, stay disciplined out there, and happy investing.